Welcome to our final segment of a 5-part series offering professionals information about the SECURE Act, which was signed into law in December 2019. SECURE stands for Setting Every Community Up for Retirement Enhancement. Visit actec.org/secure-act to find additional resources. Charitable planning and the SECURE Act. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ACTEC Fellow host with today's topic.
This is Susan Snyder, ACTEC Fellow from Chicago. Setting Every Community Up for Retirement Enhancement Act, or SECURE Act, was signed into law in December 2019. Today's podcast will discuss charitable planning tools, charitable remainder trusts, charitable giving, and possible tax traps for IRAs under the SECURE Act. To give us more information on this topic, you'll be hearing today from ACTEC Fellow Professor Christopher Hoyt of Kansas City, Missouri. Welcome, Chris.
Well, thank you very much. And building on the employee benefits retirement plan accounts, these retirement plan accounts are loaded with taxable income. And when the children inherit them, they pay income tax. And so two observations. The first one is that if you're going to make a charitable bequest, the best asset to give to charity is the stuff that has the taxable income. And give that to charity. They don't pay income tax. They'll keep all of it. And the other assets where you have a step up in basis would be good for the children. Another planning tool, though, is the Charitable Remainder Trust. And one concept is, as was pointed out earlier, when $1 million in a retirement plan account is paid to a trust, the trust is going to pay that highest income tax rate of 37%, so that your $1 million IRA shrinks to $600,000. But you can name a Charitable Remainder Trust as the beneficiary of the retirement plan account. The $1 million leaves the IRA to the CRT, and no income tax is paid. And now the charity is going to get the $1 million, but before it does, the child will get income for the rest of their life based on $1 million worth of assets rather than just $600,000. So for that spendthrift child where you're thinking, I'll have to pay that high tax rate, maybe a good arrangement is to leave the entire retirement account to a charitable remainder trust that will dole out for the rest of their life a steady stream of income. But what I really want to talk about here is the tax trap for lifetime gifts from IRAs. And the bottom line is, if you ever think that you ever want to use your IRA for charitable giving at any point in the rest of your life, then you should never make a tax-deductible contribution to an IRA after the age of 70 and a half. Now, under the old law, a person who's still working, you have to work to put money in an IRA and deduct it. A person who's still working could not make a tax-deductible contribution to their IRA. And the new law now allows working people over the age of 70 and a half to make tax-deductible contributions. But it comes with a tax trap. And basically the tax trap is, if a person ever uses the IRA for charitable giving for the rest of their life, they will recapture those tax-deductible contributions that they made to their IRA after age 70 and a half. So a little bit of background. So the 2017 Tax Act made it really hard to itemize your deductions. The number of returns that itemized fell from 30% down to 11%. So many seniors switched their charitable giving from writing a check to using their IRA. And a simple example, we have a man who has to take out $10,000 from his IRA, that's his minimum distribution, says send a check to charity for $4,000, send a check to me for $6,000. On the Form 1040, with IRA distributions, there's two lines. One line says total distributions, puts down $10,000, no penalty because the minimum was taken out. The second line says taxable distributions, and he puts down $6,000 because $4,000 went to charity. And then there's three letters. QCD stands for Qualified Charitable Distribution, tells the IRS why he's not paying tax on all 10. It's because 4 went to charity. Another example we're going to build on, there's a woman who has to take out $5,000 every year from her IRA, and she has a check cut straight from her IRA to a charity for $5,000. she'll put down total distributions $5,000, taxable 0, QCD. So this law applies to people over the age of 70 and a half. And this charitable giving law is still age 70 and a half. It has not been increased to age 72. There are basically 6 requirements to be able to make a tax-free distribution from your IRA to charity. The first is you're over the age of 70 and a half. The second is this only applies to IRAs. It doesn't apply to 401k plans or 403b plans. The third requirement is that the check from the IRA is made directly to the charity. And what this means is that the check is issued in the name of the charity. So many brokerage houses don't want to have to cut checks from IRAs, and they will issue to their IRA account owners an IRA checkbook. And every time somebody writes a check, that's a distribution. And that's a cool way to do this, is you just take your IRA checkbook, you write your checks to your charities, and they can be small amounts, $100, $50, and you're using your IRA for charitable giving. At the end of the year, you give your checkbook to your accountant, and they tabulate the total distributions and the totals that went to charity, and the tax return should be more accurate. So the third requirement is made directly from the IRA to the charity, which means the check is issued in the name of the charity. Fourth, that every public charity qualifies, except there's 3 that don't qualify for this law. The first is a private foundation that makes grants, if you have a family foundation. The second is a donor-advised fund is not eligible for this law. And the third is a supporting organization. The Friends of the Hospital and the like are not eligible. Fifth requirement is there can't be any personal benefit to the donor that would reduce the charitable gift. You can't use this to buy dinner tickets at fundraisers where there's a meal served or seats at an athletic event. And finally, the IRA account owner has to receive a letter from the charity, the normal letter that says you received no goods or services. And it doesn't have to say it's from your IRA, it just says you received no goods or services. You can deduct the entire amount. And then when you do that, you can exclude all the gifts. So here's how the Secure Act changed that. It said that if a person ever, at the age of 70 and a half, makes a tax-deductible contribution to their IRA, then their ability to use this law to make charitable gifts from their IRAs is reduced dollar for every deduction they ever took, every dollar ever deducted that was put into the IRA. So let's take the woman who's giving away $5,000 a year to charity straight from her IRA. And this year, she deducts $7,000. She puts $7,000 into her IRA and deducts it. For most people, it's $6,000. Once you're over the age of 49, you're allowed to have a catch-up contribution of $1,000. So she puts in the full $7,000. Well, this year, she deducts $7,000 going to her IRA. She has a check cut from the IRA to the charity for $5,000. So on her IRA distribution line, she reports 5,000 total distributions and 5,000 taxable. She can't use this QCD law because she took a tax deduction of $7,000. Then she makes a contribution next year of another $5,000. So the first $2,000 will be taxable. $3,000 qualifies for the exclusion. Now, of the $7,000 where it was taxable, and so she'll put down total distributions $5,000 taxable, 2 QCD for the 3. For the $7,000 that does not qualify for this QCD, she can try to take an itemized deduction. But that's the whole point, is seniors don't itemize. They've paid off the home mortgage. The most state and local taxes they can deduct is $10,000. On a married joint return, the standard deduction for seniors will be $27,000. So they really want to use their IRAs. So the bottom line is, if you or a family member or a friend is excited about putting money into an IRA and deducting the $7,000, just warn them, if you ever do, for the rest of your life, your ability to give to charity from your IRA has been restricted. So thank you very much.
Thank you, Chris, for educating us on charitable planning under the Secure Act. This ends our 5-part series on the Secure Act. Please visit actec.org/secure-act to find additional resources.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review. Follow us on Facebook and Twitter at ACTEC Talk.